Hello everyone, it's Mark here at Tesla, and unfortunately, Tesla closed red today. $230.04 was that closing price, which was a drop of $6.82 per share, or in percentage terms, that's 2.88%. Today's price action was really unfortunate because things were pretty good in the pre-market. Things were pretty decent in the futures market, and things were great yesterday in the post-market with Nvidia's earnings coming in really great. As far as beating by 25-30%, guiding up for the next quarter again as well. So we kind of have this euphoria of things will be good and decent today, but as the futures market kind of showed, that was it was coming down a little bit, not too much, but it was dropping as the early morning went on. And right at the open, the selling started. There was really no relief during the first hour or so. And to the point where that the levels that we were watching, one of them being 230, was breached very briefly on Tesla, and we rebounded off it, but we're below the 230 level now. 230 was a very high interest put strike level. So this was what we thought a floor could be, and the puts actually piled in even more so during the course of the day, and we'll look at that later. So we were looking at three levels. We were hoping that if the bullishness would stay in the open, if we can maintain that $235 level, then the bullishness would last throughout the day. You kind of bounce off it and go up and make a high. But it actually just broke through without any regards for that level. That was not of concern. And a put floor was attempted at 230, and that's kind of what where it stabilized. But what I think is actually happening was as pricing rebounded, I think the shorts piled in as far as putting in some hedges in their portfolios, because you will see when we look at the options interest, the put call ratio definitely favors puts, where Tesla is typically pretty bullish regardless of scenario. So the next level that we want to take a look at tomorrow is the 225, of course. Basically, $5 increments are pretty psychological for Tesla's movement, as they are the more popular of the increments when it comes to strikes on puts and calls. Like the in between for example, the $227.50 one, I don't think really people really care about those things, and rarely would it provide some support. Now, it has provided some support in the past for within an intraday period and quickly has sold off. So we're hoping that this could be something important to us, but the reality is maybe not. So I would say every time it closes below a level, making a new low, I would be adding in shorts. So when it did actually breach the 230 level, I did add a put into next Friday. I had 3 already, so I have 4 for next Friday, and I have some YOLO puts for hedging for any dire reactions to Powell's speech for tomorrow, and I'm long just with my shares of Tesla, and that's how I really want to keep it. We just want to survive through events like this. When it comes to like CPI or PCE or even Jerome Powell speeches, I would say your goal is to survive. You're long already. If you have shares of anything in your retirement accounts, you're long. I always say that all the time. You already are long. You don't have to go super long only to find yourself super red if things go badly. So it doesn't hurt to hedge. And like I mentioned yesterday, Thursdays are sometimes really good setups, or Fridays, because the puts or the calls, whatever the options, are just much more discounted due to the 1 day to expiration. And if you have access to 0 day to expiration stuff, I would keep an eye on the levels. Let's say there is some bullishness overnight, and let's say Tesla actually reclaims the 235 level. I would say you can maybe think about adding some hedging at that point tomorrow morning. If you see us sell throughout the evening, throughout the tomorrow morning, and we are de-risking severely, and you breach to like the 225 before even the open, and let's say there was a small relief bounce before Jerome Powell's speech, then those are your opportunities to think about, do I add some hedging here as just an opportunity, because we've already broken into the 230, we've already threatened the 225 in the pre-market or in the futures market. Just want to protect yourself. And let's take a look at that action and we'll look at the Qs, we'll look at the S&P 500 to kind of remind people, if you weren't there, this will be new information to you. But if you were there last year in August, this might be a little bit traumatic. And this is why I think today happened was, they don't want the same thing that happened to them, they being, traders or, fund managers, they don't want to get caught off sides like what happened last year on Jerome Powell's speech on the second day of Jackson Hole in August 2022. Looking at the US 500, you're seeing that this is the beginning of the speech for Jerome Powell, 10 o'clock. And you can see it's a humongous red candle. That day into the next morning, which was Monday, there's an overall drop of about 5% from intraday high to Monday's open. It's about 5%. And the selling didn't stop for many, many days as people tried to understand, what he was talking about, because everything that happened last year when it came to interest rate hikes and the speed, that's something that most people who are alive and trading nowadays have no experience. They don't know how to handle inflation. They don't know how to handle interest rate hikes to that severity. I mean, for the past, decade or so, we've been living in a very low interest rate environment. And now we're in a kind of like, well, it's high to us, but in the longer term, it's just getting started perhaps. But let's say this is it. Let's say 5-6% is it, but that's still a lot for most traders. We don't know how to react to that. And that's why the bond volatility is so much higher than equity volatility. Like the VIX is at 17 or 18, where the MOVE index has been elevated for a very, very long time, which is the index that tracks that, the bond volatility. People don't know what to do with their bonds. Like, okay, are rates going to go higher? Should I just get out of them now? Like, where does this rate hike end? Should I just get shorter term? Should I go short duration? Try to get maximum yield? Because maybe in a year, they'll be cutting rates. So everything about what happened last year was very, very uncertain. There was no idea of really how to react. So when he said pain in his speech, the sell-off was drastic. So by the close, it was 4.3%. And within about a little less than 2 weeks, you drop almost 8%. Of course, you had selling really continue until we made our double bottom lows in October. For most tickers, that was the low. But you're seeing the sharp sell-off from like inflation and from interest rate hikes. But this kind of makes sense though, right? Like if you get a big sell-off from inflation being high or the rates being hiked 75 basis points, that makes sense. But from Jerome Powell's speech, this was something that people were just not prepared for. And to have a move intraday on the S&P 500 of over 4%, that shows how a severe reaction it was to the speech itself. And the selling that came into that, the selling that happened today is really just kind of front running the possibility of downside. And for people like you and me, if you're not working with millions and tens of millions and hundreds of millions of dollars, like if you want to capture a move, sometimes you need to pre-position yourself for it, right? You need to buy a call or buy your shares or buy your puts ahead of the event, be it like an early morning CPI release or a Jerome Powell speech in this instance, and especially if those events are happening in the pre-market trading. Because if you want to be positioned to capture that move, you need to be already positioned. But, smarter money or big money or CTAs or momentum traders or fund managers, they don't really have to be positioned for a move. That's not really their concern, where the really smart money actually just, they buy or sell these breakouts. So if there was a great move in the morning based off the speech, they'll just buy at that point. And they might hold for a couple of days, a couple of weeks, where people like you and me, we don't have the ability to capture that move really successfully because we don't have maybe, the ability to buy 100,000 SPY shares or something like that right at that exact moment with some algorithm or some computer. We were just trying to enter order in as quickly as possible. And that's really inefficient in the pre-market trading, unless you're like just placing market orders for like TQQ or something. But it's still, we're not going to be able to capture that move as effectively as the people who have all the resources at their disposal and the ability to process data really, really quick, and also just have so much money to move the market themselves. We're just along for the ride. So it kind of makes sense if you are the smarter money, quote unquote, maybe you want to de-risk and not be leveraged going into Friday, not be exposed going into Friday. And they rather, even with Nvidia's great results, they'd rather just be neutral going in tomorrow or even be short, rather than take a huge loss. And trust me, it was really surprising for a lot of people last year. I remember talking to the people I trade with, my friends, and we were joking about how, this speech is going to define Jerome Powell's legacy. I remember saying that specifically, where it was specifically a legacy defining speech. I said it very jokingly, and that was before the speech happened. So as the speech evolved, and it was a very short speech, and the words pain were uttered, was it one or two times? All I remember is my portfolio balance just disappearing. And that I haven't forgotten that moment to this very day. And it's truly a PTSD thing for a lot of traders. I'm very, very sure. So they use the Nvidia euphoria to really just get out of their positions. And they sold the open like crazy. And we were here today, obviously, so we saw it. And yeah, it was still a little bit surprising for me because, I wouldn't know that they would do that de-risk now. I thought they would already be hedged, and maybe I was wrong. But I've been always saying all the time to stay hedged with your Tesla shares until we get a lot of clarity when it comes to interest rates, when we get a lot of clarity as far as what type of landing we're going to get. So, and this could be something that could last for months and months of, and I mean months of like sideways to downward choppiness, and we'll take a look at what can really solve that situation, which is going to be some clarity from Powell when we look at an article later on in this video. But so this is the move that happened in the S&P 500. It's a pretty drastic move, but even more drastic move was the NASDAQ, and the NASDAQ dropped intraday over 5% and sold off. Let's see. So if you want to look at the same time period before, from the time the speech started to where we bottomed 11, 12 days later, that was almost 10% of a move down. And it was kind of this really choppiness. So I would say, firstly, if the speech is very hawkish tomorrow, meaning that he's really pressing pain points, that selling could last a long time. And when you see, pops in pricing, as you've noticed over the past couple of weeks, anytime there's a big pop in pricing, selling comes in really, really quick because people really want to get out. They really don't want to be exposed right now. We also talked about seasonality as this week would go on, that the VIX would show some life, and you might not see relief from the volatility till maybe the first week of September. And that could be the same thing now, unless you get that clarity from Jerome Powell's speech. And we'll take a look at Tesla's price action over the course of that same time when we get back to the charts. But let's go over to the browser real quick, and we'll just take a look at a tweet or a post from Lisa Abramovich. She's from Bloomberg, and she does like the early morning show, I believe, Surveillance on Bloomberg. So she says in this post, Fed Chair Powell promised pain last year at Jackson Hole. Instead, we got big gains. This year, he must decide whether to reject the pain narrative and adopt a more benevolent approach while convincing the markets he truly has a handle on inflation. Now, what she's saying is, he was promising pain, and we experienced pain for about 2 months, basically through August, September, and October, and we bottomed at that point, and we've only been going up since. And S&P 500 is up, 9, 10%. From that point, NASDAQ maybe 18, 20%, something considerable. So if there was pain, it was very, very short-lived. The question is, does he really want to push that narrative again, the pain narrative? Because we saw what he went through when he went to the Senate and the House committees, and they were really, especially the Democrats, were really grilling him about how his very recent policy has been hurting the average, everyday, ordinary American. So let's look at the article that she links in her post, and this is from Bloomberg again, of course. And let's look at the title. It says Powell faces temptation to spurn pain and embrace the gains, meaning maybe a softer type of landing. So the first section has a headline of "Take a little bit of a victory lap." And meaning that he can basically kind of just imply that whatever he did over the last year has worked and inflation has come in, even though maybe core inflation remains relatively high. Headline inflation is very low compared to what it was, not but let's say 8-9 months ago. In the highlighted section, I've highlighted the Federal Reserve was ready to inflict damage on the economy in order to torpedo inflation. He mentioned the pain twice, so it was twice, in his 8-minute speech, talked about unfortunate costs and promised forceful and rapid steps. So tomorrow, the message might be a little bit cloudier and more academic. He'll pledge to do what it takes, as he always says, to get inflation down to 2%. But he also may lean into the idea of a soft landing, free from all the pain he spoke of in 2022. He'll probably talk about like how unemployment is at record low still, and inflation still has come in even with that really high employment, which is kind of backwards to how really conventional wisdom when it comes to monetary policy has been over the past couple of decades, where you can control inflation by encouraging higher unemployment. But this is 2022, 2021, and 2023 has been, I would say, very much out of the norm as far as the reaction to policy has been, how the economy has absorbed interest rate hikes. This is one for the history books, really. And the speech he made last year was one for his legacy and something that people will think about for the rest of time when people utter the words Jackson Hole Summit. So, article goes on to say, I think the committee should take a little bit of a victory lap here, says former St. Louis Fed President James Bullard. So Bullard stepped down from his post recently, and he was commenting that in an interview recently to Bloomberg Surveillance that they should really, come out, George, Bush style, and just proclaim that mission has been accomplished, that we did everything we needed to do. Okay, we got inflation down, and with a little bit more time, we'll probably see inflation come down a little more. That's one possible message that he could deliver. After all, since Powell's pain speech, S&P 500 is up 9%, NASDAQ 100 has zoomed 20%, and high-yield bonds have returned 4.5%. That's our long bonds, basically. Unemployment rate is 3.5%, which has actually fallen since that speech of last year, meaning that we have more employment. And the bigger challenge for Powell is what to do with these small cracks if they were to become bigger, meaning, parts of the economy, we're talking about will unemployment go higher? And is that really necessary if inflation has been taken down? Like, how much more pressure do we want to put on businesses not being able to keep their employees employed? Or how much more pressure do we need to put on even just like our treasury yields? Because the treasury yields, they will become problematic when the cost to maintain or pay for our debt at these high yields. We're talking over $1 trillion a year. That's more than our defense budget. That's not sustainable in the long term. Article also goes on to say, does the Fed cut rates in response to preserve the economic strength at the expense of getting back to inflation quickly? And we'll also be talking whether economists are starting to accept a 3% inflation target to replace the 2% figure of old, and the fiscal concerns and how they factor into higher treasury yields. So the fiscal concerns are what I talk about, like maintaining that debt. It's just too much. It's going to be like the more we pay to maintain our debt, that's less than we can invest in our own country if we need to. So I don't know how he would deliver this in his speech. And I'm speaking of, is the 2% inflation figure target not really relevant anymore? A lot of people are saying we need to accept something higher, a 3% inflation target, or something just over 2%. Any talk of that would be what people would consider a very dovish speech, meaning that the flexibility you would have on how focused he is on the 2% figure, that would move the markets up, that would bring yields down. But there's no real evidence that him and his personal outlook on that would ever change from, he's always been very staunch that a 2% inflation target is all that he's willing to accept. Ultimately, the question will come down to this: is Powell now rejecting the pain narrative in favor of something more palatable? Bullard noted the U.S. reacceleration may ratchet up the pressure to stay hawkish. So that's the balance. So what we're seeing is that, the Atlanta Fed has that GDP now, which basically gives kind of a forecast of what they believe the GDP would be for a year. And ours currently is, their outlook is about a 5.8, 5.9% GDP, which is way above people's expectations. And does that strengthen the economy, allow him to not say anything dovish at all? And if that's the case, what we're going to see is we're going to see yields go up. That means equity goes down, and that this sell-off was a 2% sell-off today. Maybe you finish it off with another 2% sell-off tomorrow to make it that 4% sell-off like it was last year. And the selling would continue for days and days and days. Like, we're not going to get PC inflation until next week. We're still going to get CPI before next FOMC. So that brings us to what? 4 or 5 weeks of selling, of sideways action, of basically theta destruction when it comes to options, the choppiness in the market, and just really much more uncertainty. So, ideally we want answers. This article says we won't get any. And that could be rather problematic for price action, especially for something rate sensitive like Tesla. So let's take a look at the options for the S&P 500 tomorrow to kind of get an idea of what we're looking at when it comes to potential moves for tomorrow. We can see a lot of interest is already piling in for the 436 SPY puts, which is just right under the closing price of today. And there is a lot of puts that you see in the volume. You can see that the 440s were opened up like crazy today. They were opened up in the morning. A little bit of call buying was done at the end of the day. So that could be a good sign that as the market was selling off, especially towards the end of the day, some people were positioning a little bit more on the long side. Not a lot, but there was a noticeable uptick in people positioning, not for tomorrow's expiry exactly, but over the course of the next 2 or 3 weeks. There was a little bit of more bullish positioning, and that also can just be upside hedging if they're all really net short. And I think a lot of people aren't net short. You can see the put call ratio for tomorrow on open interest alone is a 2 to 1, meaning that there is a lot of put open interest, around 800,000, compared to call interest for tomorrow's expiration. And let's look at Tesla. So we talked about how 230 was a floor, and you can see how the 230 was really respected. There was a lot of volume in 230. This built up very, very quickly over the course of the early morning hours, and the 235s were actually being bought as well. So this kind of says that going over 235 would take a very dovish speech from Powell tomorrow. Something really, really bullish for the markets is going to be that inflation target being adjusted, or some sign of clarity of interest rate cuts or further pausing from interest rate hikes. Without any clarity, this you'll start to understand as the price action unfolds in the morning that the 230 put floor is not a floor. That is actually people positioned because they know they're going to sell, and they're all ready to go. They're all ready to sell, and that could be that's not going to be great for Tesla. And you look at other $5 increments below as the real floor for tomorrow's action. So I would say watch your options chains, watch where the open interest is piling up at, watch the different sites that you might use to find positioning for the real big players, which is the fund managers, the momentum traders, and what have you tomorrow. Try to be on their side. Okay. Remember, just one thing: you're already long. You don't have to go double long unless you're provided with a really good opportunity. But let's look at the charts again. You would think today presented a lot of great opportunities to buy the dip or what have you, and only for it to keep selling all day long. So just be really careful. Remember, you're long already. What you want to do is how do you beat everyone else? Is you minimize your downside. If you minimize your downside, you'll eventually beat everybody, because there's a lot of people who invest in Tesla who don't understand that this stock hasn't gone anywhere for years. It's not going anywhere. I'm not saying it's not going to go somewhere, but in this environment, in this economic condition of high interest rates with no idea of when they're going to stop, that's going to be really, 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 really painful for Tesla. But what you can be doing with your Tesla shares, you can be using that all that capital, your principal, to create income from yourself. You can sell calls and you can hedge your downside. So everyone who is not actively trading, quote unquote, you or people I hear on YouTube all the time, you can't trade Tesla. If you just minimize your downside a little bit, you will beat them all because you are not losing as much as they are. There's days, and you know it because it happened recently, there's days when Tesla's losing 2 to 3%. When that compounds over and over again, you're losing how many percent every month? The up and down swings of Tesla is creating no upward trend at all. We're still in a downward trend. No, this stock isn't going up compared to so many other tickers. And even just the index itself is so much more stable and has gains over the past 2 years compared to Tesla, who's actually at a loss over the last 2.5 years. So I would say, if you were presented with really obvious opportunities to go along, I wouldn't mind anyone taking those. It's just that let's look at the minute action on Tesla today. So if you were here at $233 when it was trying to consolidate in the morning, it was trying to catch itself. If you went long there, that thing is worthless now. I mean, you probably lost like 70% of the value on that, or 50% of the value on a call. If it expires tomorrow, it probably lost 80% by the close. Now, I'm glad to see that after hours pricing is just in line with the actual closing price instead of being at the $288 and like 60 cent mark from a couple minutes ago. But this sell-off is just so obvious that people just don't want to be exposed to tomorrow. And it's possible that they'll sell the futures and they'll sell the pre-market action. Is that your opportunity to go long? I am not sure. Of course, no one knows. But further selling at least can make going long a little bit cheaper. Let's take a look at the pattern that we were looking at before. And we were looking at this cup and handle pattern. I think we can obviously say that this triple top has sold off. This is like a swing failure working itself out. But we didn't make a new low. Like the low wasn't closing below 230. I don't know. That bullish? Who knows? But just watch 225 tomorrow. If you're near 225 by the open, just be really careful. Like you can maybe dabble for a long a little bit, but just know that sometimes that the open is very, very different, even from 1 second before the open. Like what was today, for example? I believe like you're maybe seeing like something like $239, $240 in the pre-market at times, and it like once it opened, it was like 238, 237, and it was just like they need the liquidity, right? So if you're going to sell a lot, you want the market to be cash hours. You want it to be regular trading hours so you can sell into much more liquidity. And that's what they did. They're just waiting, biding their time, and all the smart money sold everything. And they bought a little bit of it back at the end of the day, but really not a lot. And they did a good job of scaring a lot of people out of their positions, and it got bought back up. But I really do believe that when they bought it back up into this 233 area, this was just them loading more shorts to make it even cheaper to hedge for the next day. Let's go over to like the hour time frame, and let's try to find August 25th, 2022 in our chart and see how Tesla reacted to that situation. We drew these boxes for a video a couple of weeks ago. Let's delete those. So here's August, and here's August 25th. So the speech happened right after that. Okay, so from the intraday high on Friday, the 26th, that is, to the low of, let's see, what was that day's low? I guess it's going to be right here. We dropped around 6%, okay, from the high of the day to the low of the day. Now, we did front run. I believe we did. I believe we front ran the speech today. So this sell off, let's say a 2% sell off, could mean that even in a really bad scenario, maybe we don't sell off 6.5%. Maybe it's 4%. Who knows? Obviously, no one knows. But I think a lot of that selling that happened today was just so they don't really experience the same type of catastrophe that everyone else did last year, same time. So that wasn't the end of the selling though. So in I would say if this goes really badly tomorrow, let's just look at what the overall over the next, I would say that was 1 week for Tesla. It wasn't 11 days because it actually did the double bottom. So for a week, it sold and it dropped 12%. What does 12% look like on our current, in our current pricing? Oh wait, are we? That's so sad. I was just looking at where we are in price now, and it looks like we're lower than Jackson Hole's pricing was last year. That just makes me super depressed. Anyways, okay, so if we were to sell a 12% move, oh, it's not even on the screen. Let's say we were to sell 12% over the next week. It would actually take us to the previous area of interest, which we thought it would be somewhere around here, where it would bounce, and it did. And a 12% move down from today's intraday high would just be like a possible double bottom, or basically a new low. But obviously, we don't know what's going to happen tomorrow. I just say that, given the action today, maybe we de-risked enough. But if given the opportunity to hedge further, I personally will take that opportunity. If there's any bullishness in the morning, though it's really not that much time, it's like only 35 minutes, and we don't know how the futures market will be treating Tesla over the next 12, 13 hours. It could be, there might not be an opportunity there to hedge. But, price is maintaining in the after hours, so that's kind of okay. Let's look at bonds real quick and how bonds reacted. So it bounced down from where we thought it would. So our long bonds, the yield has come up, and we figured after that really sharp move, there should be some retracement. And if there was going to be another bottom, maybe it sees 93 again during the course of the next 1 or 2 days. And maybe that's the bottom for yields, or the top for yields, really. Let's look at Nvidia, and in comparison to Tesla, Tesla actually held its own. It didn't make a new low for the day, where Nvidia made new lows during the course of the day. It's really unfortunate because Nvidia really did have a really good earnings report, but this could be a great opportunity if you're not positioned in Nvidia. Maybe this is an opportunity to get into this ticker in the next couple days. And I don't mean now, because we really don't know how Nvidia is going to react to the speech tomorrow. So taking new longs, I'm not going to be suggesting that to people right now, because most likely they're already positioned long somehow, some way. Let's look at the car sector again before we close up the video. And you can see that with Tesla being in the light blue, Rivian being in the orange, and Ford and GM being these two similarly moving lines here, that everything is sold off. Everything's sold off. So there's no real under or outperformance based off the volatility or the beta of their ticker. So everything seems pretty in line here. No one's really outperforming, and it's just a general sell-off for the entire market. No one really did really well today, unless you were long VIX and short the stock market. Looking at the VIX, we can see that we talked about buying VIX because we talked about how the seasonality for the volatility of the market would increase as this month ends, and we still have a couple days left in trading this month, and it doesn't really taper until the first week of September. But I think that's all for now. I would say just hold on and try to survive tomorrow. And just once again, remember, you're already long, right? So thanks so much, guys. I'm sorry for the red day, but we did have a couple days of green, and a pullback is maybe expected, not a severe pullback like this, especially after good news in the tech world. But honestly, I don't think any of us are surprised. All right, take care, guys. Bye.